Whenever I look at this equation, I kind of see it from two different angles. I shouldn't say two different angles, but two different circumstances, situations. Number one, I'm looking at like you said, mentioned the long term, whether that is probably gonna be more of a retirement picture, but I'm also looking at the savings to buy picture. And I think that's obviously where more of the debt factor comes
Mhm.
in. So, going with that first endeavor, you talk about the long term, the retirement, the savings. Um, there are a lot of people, especially in the ag community, but I know this is also the case outside. Really, anyone that I think deals with real estate or deals with business ventures um, could very easily argue that retirement equity and assets could be built up through land and through business acquisitions and through those what we call tangible assets. And you
Mhm.
obviously can buy those with cash, or you can use the debt and the financing on that. Um, but either one of those two routes allows you to build up that equity, that asset base, that at retirement, then if you've got the real estate, if it's income producing real estate, you can draw retirement income off of that. If you've got business, you can maybe draw off of the profits of the business, or you can sell that business and have that exit, be your retirement. There's several different ways that I think people can look at a long term asset use of that. If you go with more of the investment option with the pure stock market cash basis, um, I think there's a lot more risk associated with that. Like you mentioned, you cannot time that market. It's not something that you can put your money into and be guaranteed that's going to increase in value like
Mhm.
land or real estate typically is. That's not always the case with the housing market, but generally speaking, your real estate is going to continue to appreciate. Generally speaking, if the business is run the right way, it's going to grow in value. The market
Mhm.
doesn't have that guarantee. Long term speaking, you're going to have a high you're going to have a return long term because of the market shifts and just the way that inflation runs, the way that businesses operate. Like you mentioned, if you diversify that portfolio long term, you're going to have a positive result. Now, to get that long term result, you've got to be committed to long term, to 10,
Mhm.
20, 30, 40 years, whatever it is, um, from a retirement investment standpoint. I know people like my in-laws, they have zero interest, zero comfort with putting a single dollar in the stock market. Vast majority of their cash is sitting in the bank in a CD or a money market savings because they trust that is a low risk, even though it's low reward. They're comfortable with that. And I've
Mhm.
commented to my wife before that in that instance, I believe that people are good at saving money, but not good at making money. Um,
Mhm.
so it's a dynamic perspective, I think, whenever you look at the retirement side. You've got to be committed to the long run, regardless. When you're looking at the investment side, um, and you got to understand it. If you don't understand the market, you're always going to consider that a riskier endeavor and investment and place to put your money. So, we definitely don't want anyone to do something that they don't understand, because that could have a backfire and you do lose money because you're putting your money in the wrong spot.